In our previous segment on annual dividend futures, we saw that expected growth in dividends over the next decade had collapsed, and a dividend futures now price only 8% growth in S&P 500 dividend payments between now and the end of the year 2030. Part of the reason for such modest expectation lies in the market's recent history. In the 1990s, S&P 500 dividends grew by 43%. In the 2000s, meaning between 2000 and 2009, they rose by 37%, despite the tech wreck and the global financial crisis. However, during the 2010s, S&P 500 dividends grew by an explosive 155%, a pace that almost certainly cannot be matched in this decade going forward. Hence, investors' very modest expectation for only 8% growth between now and the year 2030. But for a deeper understanding, let's look at the fundamental equation of dividends. Aggregate dividends should be equal to nominal GDP multiplied by corporate earnings as a percentage of GDP, in turn multiplied by the payout ratio, or the percentage of earnings paid out to investors as dividends. Breaking down this equation into its component parts gives us insight into why the market is pricing such slow dividend growth. So let's begin with nominal GDP. Nominal gross domestic product itself can be broken into two parts: inflation and real economic growth. Starting with inflation, break-even spreads between nominal 10-year U.S. Treasuries and 10-year inflation-protected securities, or TIPS, anticipate an inflation rate over the next decade of only 1.5% per year. So the markets don't expect much inflation, and that means that there's not much of an inflationary boost for dividends going ahead in the view of the markets. When it comes to real economic growth component of nominal GDP, things don't look much better. For starters, unemployment fell from 10% at the end of 2009 to 3.5% at the end of 2019. Labor force participation has improved slightly, so it is possible for more workers to come off the sidelines and into the labor force. But long story short, in the 2020s, the economy can't grow quickly simply because more people are working. And this is not uniquely a U.S. phenomenon. Australian, Canadian, European, and Japanese labor markets have tightened as well. In all of those countries, along with China, have very slow population growth. As such, this leaves improved productivity growth as the main hope for higher dividend payments and higher real growth in the economy. Next, there is the issue of corporate earnings as a percentage of GDP. As of Q3 2019, corporate earnings were 9.6% of GDP, relatively high by historical standards. During the 2010s, pre-tax corporate earnings ranged from 9.5% to 12.5% of GDP, when corporate earnings accounted for about 7 to 12% of output historically over a longer period of time. Dividend payments got a one-time boost in 2018 from the cut in corporate income taxes from 35% to 21%. This tax cut, however, won't likely be repeated, and corporate tax cuts are either likely to stay about the same or maybe go higher into 2020s, depending on election outcomes. Finally, there is the issue of the payout ratio. The payout of earnings to investors as dividends has remained largely stable at around 1/3 during economic expansions. That ratio tends to soar during economic downturns like in 2001 and 2008, only to return to normal levels as the economy and corporate earnings recover. There is little reason to think that corporations will pay out a greater percentage of earnings in the 2020s than they have in the recent past. In summary, markets think that inflation and real growth are both likely to remain low. Corporate earnings might shrink relative to the size of the overall economy, and the dividend payment ratios are unlikely to change very much. For those four reasons, in combination, paint a picture of slow growth in dividends during the 2020s. I'm Eric Norland, Senior Economist with the CME Group in London.